I was able to take equity in my home and convert that into a source of cash flow for retirement just on having a basement rented out, a third of it. So I think there's some interesting
Yeah.
opportunities, particularly as people start to, age up and they look to maybe move and relocate. How do you access that capital tied up in your home and the four walls and maybe convert it into something that'll produce cash flow?
If you're a real estate agent earning $200,000 a year and you want to grow your passive income, this show is for you. Learn secrets other agents use and hear from experts in our field who will guide you on your journey to investing in assets like apartment communities so you can take your commissions and turn them into cash flow. Here's your host, Randal. Let's dive in.
Hey, welcome back. Today's guest is Scott Saunders. We are going to talk about 1031 exchanges. He is the Senior Vice President for Asset Preservation, Inc. He's a national speaker. Guy knows his stuff. He used to be a lobbyist in D.C. for taxes. And we go through and talk about some of the very cool things that he has seen with 1031s. I learned something, even though we've had other guests on talking about this. I definitely got value out of the show talking to Scott because, again, he just knows his stuff and he's seen some cool exchange ideas and he provides a few that you can actually use for your primary residence as well. So if you're getting something out of the show, please go on, rate and review. Helps us a ton. As a reminder, we have the Ram Capital Fund one that we're raising capital for right now. It is a single family or a note business that we're offering up to 10% preferred return for your invested dollars paid out quarterly. And that is happening now. So if you're interested in that, there's a link in the show notes, or you can go to ridgelineig.com, click on the offerings tab, and it will be in there as well. So let's jump into the conversation with Scott. Here we go. Hey, Scott, welcome to the show. It's good to have you on today. First off, before we even get started, I want to ask you, not 1031, I want to ask you about your personal investing. So you just told me just now you got 77 doors. Is that right?
77 assets. So
77. Okay.
yeah. Hey, Randall, great to be with you. Super
Thanks.
excited to talk about 1031. And yeah, I drank the Kool-Aid. I love real estate, right? So I buy assets, I exchange my own assets. I'm at 77 now and trying to grow and scale that, build it up a portfolio, primarily single family rentals. So
Okay.
just little small assets, typically in the Midwest.
Okay. So your strategy, since you're a 1031 guy, has it been just buy and roll? Like, what's the strategy on the investing
Yeah.
side before we get into the...
Yeah, great question. I mean, 1031, as you know, is such a powerful way to kind of redeploy. So I've done a few exchanges where I'll take one asset and I'll exchange it for five more and add some leverage. So it's a great way to scale a portfolio. You take one asset that's gone up with some equity, rather than selling it and paying Uncle Sam all the taxes, you just redeploy the capital. And a lot of times I'll leverage it up to get a better ROI, get a little bit better return on it. So that's what I've been doing.
Nice. Okay. So again, talking strategy just in general, is there a time frame you typically wait, or is it an equity amount that you're waiting to see before you actually 1031 out?
Great question. A couple things. One, it could be equity. I want to get substantial equity where I've got a few $100,000 equity. Sometimes I'll redeploy if I bought an asset that just didn't meet expectations. So, as you buy assets, we all want to bat 1,000. The reality is none of us do. So sometimes the smartest thing you can do as an investor is look at an asset and go, hey, look like a good buy at the time, but for whatever reason, it's not performing. I had one I rolled out of in Florida where the HOA fees kept going up. So I had cash flow, but every time I'd bump the rent, the HOA fee would go up proportionally. And so I knew at the end of the day, I was never going to get more than $300-400 a month out of this. Even though it performed, it wasn't going to really grow like my other assets. So I rolled out of that and happened to roll that into a 4-bedroom, 2-bath in Cleveland that's doing way better on cash flow and is appreciating.
Awesome. Okay. So again, you just mentioned you have two assets, two different markets. You're in Colorado yourself. So strategy wise, are you buying all over the place? Are you looking short-term rental of these things? What is...
You know what? I'm all long-term. I got one midterm rental here in Colorado up in the mountains. Everything else is a long-term rental. So what I do is typically like a turnkey asset. So I've got a relationship with some providers where they'll manage, the local portfolio for me. So I outsource all of that. I'm just focused on growing assets. I don't have the bandwidth to try and manage remotely. I'm happy to pay a little 8% fee to somebody else to take care of that for me.
Yeah. So then how did you pick these markets? Are you going to Florida? You needed a vacation place for yourself, or you just...
Yeah, that was a long time. I mean, right now I like the Midwest markets. I love like a Memphis, a Little Rock, a St. Louis, Kansas City, Jacksonville. So, I mean, some of those markets are really good. I've got assets up in the Ohio, Dayton, and Cleveland. I would say over time, I'm migrating a little bit more south. I just like the warmer weather. I prefer to get an asset that's like a slab on grade versus a basement, just a
Yeah.
little less maintenance, things going wrong. I've dealt with enough flooded, leaky basements that, I'll keep the ones I have, but I ain't gonna go forward. I'm trying to upgrade and do slab on grade and just
Got
have a
it.
little more simplicity.
Yeah, yeah. Got it. Okay. All right. So that's on the investing side. Just kind of curious. Again, you,
Yeah.
you kicked it off. I'm like, hang on a second. You got stuff going on all over the place. You're talking about your daughter working with you and managing all those things. So I mean, we could go down that rabbit hole, but let's talk 1031s for listeners who may have heard about it, but haven't heard either one of our prior episodes or heard exactly what it is. Why don't you high level it and then we'll kind of dive into some of the topics that we were talking about a second ago.
Sure. High level, a 1031 exchange just allows you to take any property held for investment or used in a business and exchange it and acquire what we call other like-kind property held the same way. So the most simplistic thing, if I sell an asset and I get cash, taxable sale. If I have a property held for investment, I sell it in what's called a delayed exchange, I get back a like-kind property. So a sale, property for cash, exchange, property for property. And believe it or not, Randall, it's been in the tax code since 1921. So we're not talking about something that is this, really creative out there strategy. This is something that has been through boom cycles, flat cycles, recessions, and it really is a tool that allows your average real estate investor to build and scale and grow a portfolio, right? You start with one asset, you go to two, you go to four, you go to eight, then maybe you go from eight into a smaller apartment complex. And a lot of the investors that are in the commercial space today, they started with residential real estate and they just kind of exchanged their way up the food chain of assets until they got into commercial assets.
Yeah, it's the way to go. So let's talk about the combo and the strategy that you were talking about, because a lot of real estate professionals, they work out of their house. They've got property that is there. They may sell their home and never think that they could 1031 any part of that. And so just hearing you talk about it a second ago, I was like, okay, this is definitely something we need to touch on. So can you break down how that process works? And to me, I guess one of the questions would be, when does that actually make sense? And are you actually seeing enough of a benefit of the 1031 to actually do that? Right. So maybe
Yeah.
break
So
down that strategy.
sure. So it's what I call a split treatment strategy. You've got one property, it's called a single family home, but you really have a couple of different uses. You live in it, but you also have an office, or maybe somebody is there with an office. I know people that are builders have a home office and then they use their entire garage to store construction materials. So it's a way to kind of rethink about an asset and think about, how am I really using it? So if you've got an office or business use of a residential property, that would qualify for a 1031 exchange. So Randall, the example I gave to you right now, I'm talking to you from the basement of my home. So the entire basement, which is 1/3 of my square footage, I use for business. I do things like this podcast. In the main area, I've got several desks set up. My daughter has one. I have one. I've got an area where I've got all my files. I've got a conference table where I'll do business meetings. It's 100% business use. So to give a simple example, when I go to sell my house down the road, because the basement was used for business and I depreciated it just like I would any other business or investment property, when I go to sell it to one buyer, 1/3 of the property, I'll do a 1031 exchange on 1/3 of it. And that just happens to be because that's the square footage allocated. I'll exchange it for another investment property. Then the main level in my upstairs, I live in. Section 121 applies. And most realtors know that. Just the primary residence rules. If you live there 2 out of the 5 years, you can exclude $250,000 if you're single, $500,000 married, filing jointly. So I think there's a planning opportunity there for people to look at, particularly now, kind of post-COVID. A lot of people have home-based businesses where they've converted some of their home into legitimate side hustles where they've got an office, or maybe they've, converted a basement or an exterior garage into something they use for business, woodworking, you name it. Kind of look at that asset and say, hey, is this really just a home, or is it a property they live in, but they also take a portion of it and use it for business? A real simplistic example would be, what if I've got a fourplex? I bought a fourplex. I live in one unit, maybe fixed it up and made it a little nicer. I rent out the other 3. When you go to sell that, 75% of it, the 3 units that are rented, you can do an exchange. The one you lived in 2 out of 5 years, you pocket that money and the primary residence rules apply. And so I just think there are a lot of planning opportunities. I mean, you can expand it from there. What about somebody with a ranch or farm? The dirt's worth 2 million bucks, but they live in a modest $400,000 farmhouse, right? That farmhouse is the 121 portion, but the farm that they've been operating qualifies for a 1031 exchange because it's real property that they've been using in their business. So, we do that with ranches, we do that with farms, lots of different applications. You could have a mother-in-law unit, right? A detached garage that you rent out to college kids. It's an investment property. And so all that square footage, you can do an exchange on it. So lots of opportunities out there. And I think real estate professionals might, if they look through it that lens, they might look at a house a little bit differently and look for some opportunities to maybe help their clients with taxes. Think of a place like California where properties have just popped up in value over the last 20 years. That 250,000 exclusion if you're single doesn't really cover you that much. You're going to need some other tax strategies. So look at that and say, hey, is there a planning opportunity where some of that was legitimately used in a business? Maybe it was rented. People do Airbnbs on a wing of their house, right? That's an investment property. So if you've got a dedicated couple bedrooms and a bathroom for Airbnb in your home and maybe a little exterior entrance, you can do an exchange on that portion.
Hey everybody, Randal Declared here with a special shout out to our friends over at Envone. If you're looking to diversify your investment portfolio, you've got to go check them out. It's envone.com. It's a crowdfunding platform with a wide range of investment opportunities, things like real estate investing and even bourbon barrel investing. So check them out. Envone hosts our crowdfund. It's actually a single-family real estate investment fund that we have launched with them, and we've had an awesome experience working with Levy and his team. They're super responsive, very quick to assist us with things that we need, and they have crowdfunding down to a science. Go ahead and check out episode 154, where Levy and I discuss crowdfunding in detail and how it can help you either invest or raise capital. And check this out. As a friend of the pod, launch your crowdfund with Envone, and you're going to get an exclusive 10% discount when you head over to envone.com/ABC, or simply call Levy and his team at 475-800-8716 and mention Agents Building Cash Flow. Go crush it. Happy investing. Talk to you later. Got it. Okay. So then when you are exchanging out, so take your house, for example, you sell, you have a third that you are going to exchange. How does that work with the financing when you're going to buy a new property and some of the logistics? So you need all of that capital. Say you're selling, you need all that capital though to go buy your new property. You're going to have a step up, right? You have to spend more than what you sell for, correct? On an exchange.
Yeah, correct. The real simple rules on that, there are two different rules you need to meet. Number one, you've got to reinvest all of your net equity or the net proceeds, right? So kind of after closing costs. Number two, you've got to have the same or a greater amount of debt or mortgage. So if I have a mortgage, let's just make it easy, of 300,000, 1/3 of that mortgage would be within my investment portion. So I need to have a mortgage of 100,000 or more, and then take 1/3 of those net proceeds and reinvest those. Those are the basic rules in any exchange.
Yeah. So again, when you're going to acquire the new property, if you're using not just your 121 or the proceeds that you got from the personal side plus the business side, again, how does that work? You're just taking the tax benefit on the exchange portion, but you have to roll it in and you have to basically set up another 1/3 of your new home as your office. Is that correct?
Yeah, I see where you're going. If I have another home that I'm going to go into and I want to treat it that way, I would, but let's make it even easier. I'm in my late 50s. Let's say I want to downsize. I don't need as many bedrooms as I have now because my kids have kind of moved on, right? I might just go buy a home with the residence portion that's smaller, and then I might exchange for just one single family rental in Memphis, Tennessee. And I just go ahead and I look at whatever 1/3 of my property is, and I just buy a standalone one single family. But just think of what I've been able to do there. I was able to take equity in my home and convert that into a source of cash flow for retirement just on having a basement rented out, 1/3 of it. So I think there's some interesting opportunities, particularly as people start to, age up and they look to maybe move and relocate. How do you access that capital tied up in your home and the four walls and maybe convert it into something that'll produce cash flow? So for a real estate professional, what a great strategy to at least talk to about their clients. I'm not sure every real estate professional is thinking of that. And Maybe it helps somebody get a listing, right? Or build a client relationship, but that could be a game changer and make a deal, make the difference of getting that deal and putting it together or not. So
Yeah,
it could be a cool tool.
definitely. I mean, it's something I've never thought of or heard of. So I'm sure there are other agents that are in the same boat. You're also talking about like DST, Delaware Statutory Trust, and that sort of thing. Can we touch on that a little bit and when you might use that and why?
Yeah. So there are different things you can go into. Like kind property could be land into single family, commercial, industrial, anything held for investment. But there's this category of what I call fractional ownership out there. So a Delaware statutory trust is one variation, and the other is what's known as a TIC or a tenant in common. These are unique programs, and so they're very, very different. They're sold by securities brokers, people that have the appropriate securities license. So the SEC considers them a security, but they're qualifying as like-kind property for a 1031 exchange. What these typically are is where somebody gets a larger commercial property. Let's say it's a $30 million apartment complex. They're going to manage it. So you, in doing an exchange, instead of going from your houses that you manage, very active, you now want to go passive and have somebody else take on all the management responsibilities, vet the tenants, and do everything. So a DST is a Delaware statutory trust, and you just get a little slice of that larger $30 million complex. So if you've got $1 million equity, you get 1/30th of that. But it's a really popular strategy now for people that don't want to pay the taxes, but they want to convert that equity into cash flow, but they don't want the management responsibilities. So they started out back in 2002 in tenant common ownership. Today, most of these are done in a Delaware statutory trust. Now, it's not something everybody can access. You've got to be what's considered an accredited investor. So you've got to meet that standard. So that's what the SEC considers and what's known as a Regulation D offering. So it's for somebody that's a little bit more sophisticated. They've got a little bit more capital. And if that investment doesn't perform, it's not necessarily going to blow out all their finances. But this is a very popular niche. There are billions of dollars of these happening every year. And where they're kind of cool, Randall, what if you're doing an exchange? We haven't talked about it, but when you sell, you've got 45 days to identify and a maximum of 180 days to close. What if you're sitting there on day 43 in your market and you can't find anything? Your stress level's going up because you're like, man, I'm going to be stuck with this big tax hit and I only got 2 days. Because these are kind of this hybrid of a security and real estate, a lot of these sponsors that put these together, they might have an offering where you can call them up and say, look, I've got 452,000 equity. I need 300,000 debt. And they go, perfect. I got something right now. I'll carve it out for you. So a lot of times at the last minute, these can be a great way to kind of save an exchange where maybe you're not finding any inventory that meets your needs in the marketplace. But primarily, people are doing them because they're going passive. They're sick of the management responsibilities. They don't necessarily want to go into like a triple net offering, which is fairly management, free. And this is another alternative. And, one thing people do is you can still diversify. So if I've got $1 million in equity, Randall, I could put in a third over in one DST, a third in another, and over here. So now I can even diversify into different sponsors and different programs. So I don't have all the eggs in one basket.
Yeah. So we talk about this a bit and we've done some ticks and that sort of thing, but definitely if you're looking at doing that, then vet the sponsor before you do your 1031. 100% before you even start that 45-day sale. You don't want to be at day 43 and then you're like calling just Joe Blow to throw some money at them.
Yeah, super important point. I'm glad you brought that up. Look at their track record. There are a lot of new entrants right now. I don't know if they're good or not. There are companies that have been doing this for 10, 15, 20 years. If it were me, I'd rather go with a company that has been through some economic cycles. They've got some financial wherewithal doing it. So yeah, vet the sponsor because you're really entering into a long-term relationship. You're going to be holding this asset for 4 to 7 years with that company, that sponsor. So you want to do your homework on them, look at your offering, get a good tax advisor or financial advisor to look at it with you. You get what's called a private placement memorandum, a PPM. Read it, study it, look at who's going to be leased in there. Are there rent escalators? Look at the risks, but study it like you would any other investment. A lot of the financial advisors that promote these, they'll talk about, it's mailbox money. Well, that's great, but you and I are in the real estate industry, and I know real estate, it fluctuates, right? It's not necessarily 100% consistent. So you want to look at who you're going to get into that long-term relationship with and vet them. Great point.
Yeah, it's just one of those. I mean, we talk about it a lot. So the other question I've got, structuring it as a tick compared to a DST. Like, again, when you have, maybe it's a $5 million raise and somebody has that $1 million, the sponsor can carve out a tick. What's the difference in a tick and a DST?
They're fundamentally completely different structures. So at the end of the day, they're both fractional ownership. The tick is governed by what's known as Revenue Ruling 2002-22. So I can have up to 35 investors in a tick.
Okay.
A DST, I can have hundreds. So you got a little bit more flexibility right off the bat with the DST because you can accommodate a lot more people. So there's some other, subtleties. I would tell you in the marketplace today, 95% of the deals are done as the DST structure as opposed to the tick type structure these days. It's just, it gives a little bit more flexibility.
Okay. Yeah. I've seen the tick recently. I haven't on the DS. That's why I asked. I was like, okay, I don't know exactly. I've heard of it. I've seen it, but not as much, which is surprising.
Yeah. Here's what I'll do for you, Randall. I've got a comparison, a little write-up I did comparing a tick to a DST side by side. I'll email that over to you if you want to include it in the show notes. That'll give everybody kind of a visual that'll show side by side what they're like. Happy to do that.
Yeah, that'd be great. I appreciate it.
Cool.
Okay. So you also mentioned something else. I'm kind of curious, just you're in it. You're a QI, right? Qualified intermediary. Okay.
So I'm a senior vice president with asset preservation. We're a national qualified intermediary.
Yeah. So what are some of the most interesting types of exchanges that you have seen? Because, I mean, you've mentioned a few that I haven't even thought of, and you've talked about air rights, water rights, that sort of thing. So are there some really interesting investments that you've seen come across because of what people are exchanging in or out of?
Yeah, boy, now you just asked me an open-ended question. I can go all over the place. Let me share a few.
Let's go.
This is kind of the cool part of exchanging. So think of it this way. As long as it's considered real property under state law, you can do an exchange on it. So in Colorado, water rights are considered real property. They're not in Washington or Oregon because water's plentiful. So a lot of the drier states, water rights are considered real property. And air right, we do these all the time. They're what's known as a transferable development right. And to give you a simplistic example, I'm in New York City. I got a 30-story building and I want to add 10 stories. I've been granted the right to do that. It's literally just a right to air to add 10 more stories. I can exchange out of that air right, TDR, and exchange right into an apartment complex. We do exchanges on all sorts of different easements. Here in Colorado, we did a conservation easement deal where land was in the family for 100 years. The city of Boulder wanted it. It was going to give them about 300 acres. Give them some hiking trails, a little train route, a watershed. So a lot of like recreational and also just good for the environment things. They exchanged out of that. It was like an $8 million deal and exchanged into apartment complexes. But if they had to pay the taxes on that conservation easement, they never would have done the deal. We do exchanges on, if you ever heard it's a mouthful, a perpetual communication easement. It's a cell tower. The cell towers are purchased for somewhere between $200,000 about $1.5 million. So if you got a cell tower and you want to hold on to your land, you can hold on to that. You just create a new perpetual communication easement for the cell tower, do an exchange just out of that into another asset. So oil and gas qualifies. There's certain oil and gas programs that are considered real estate. So you can go into mineral rights, oil and gas. One that I think is awesome, and I'll share with everybody, it's great for real estate professionals, great for investors. A vacation home held for investment. There's some rules for that, but you can come out of your investment property and you can exchange into a property at a beautiful lake that meets a few basic requirements, and that qualifies under Section 1031. So what a cool way to take equity that was an investment and now kind of convert it into what I call a lifestyle asset down the road where the family can hang out and enjoy it, all without paying capital gain taxes.
So what are the rules on that? Is that you have to put it in service or something?
So it comes from something known as Revenue Procedure 2008-16, but the simple way to remember this is just remember it as the rule of twos. You've got to hold on to the property for 2 years. So you got a 2-year hold period. Yeah. You have to rent it for 2 weeks in each year. Easy to do in a vacation area. The last one is the kicker. Everybody hates the last one. Your personal use can't exceed 2 weeks or 10% of the time it's rented. So let's just say you said you go to Breckenridge sometimes. You got a place in Breckenridge. You want to use it for skiing. For the first 2 years, you got to keep yourself under that 2-week threshold. The beauty of it is after the 2 years are up, you can do whatever you want. You can use it as much personally. You can rent it as much. You could have it sit vacant. You just need to meet those three basic rules, and then it's considered held for investment. So all over the country, every state's got a vacation property, right? I mean, you go to Minnesota, you got beautiful lakes. I'm in Colorado, you got the mountains. You go to Arizona, you got golf courses. You go to Florida, you got beaches. I mean, I can't think of a state out there that doesn't have some desirable recreational vacation property. I think this is just a dynamite approach to get something that maybe performs well as an investment, and you also get some personal perks out of it.
Yeah.
You got to use it some of the time.
All right, that's interesting. Okay, so let's talk about, I guess, some of the logistics. You know, the timelines, we've already covered those, but cost wise, what does it typically cost, and when does it make sense to do an exchange?
Yeah, cost for exchange pretty nominal, right? For qualified intermediary, they step in the middle of the transaction, they prepare some paperwork, they're going to hold the money. So that's really key. You can't get the money, you can't access it. You got to set up an exchange before you close on your sale. You can't set it up after the fact. And that a lot of people think they can do that. You got to set it up before you close so you don't have actual or constructive receipt. Typical qualified intermediary fee is going to be somewhere between $900 to $1,500, somewhere in that range. We charge $1,250, allows you to sell one and buy up to three. So, somewhere in that ballpark. When does it make sense? Let me kind of answer that question another way. Like, when does it not make sense?
Yeah.
If you don't have any gain, don't do an exchange. And then the other one would be if you're going to get out of real estate. If you want to go invest in crypto or Google or Facebook, you probably don't want to do an exchange. But in my opinion, especially real estate professionals that pick up deals that are good in the marketplace, most of us in real estate, we like real estate. We know how it works. We know how it's valued. If you're going to go buy more real estate, it never makes sense, in my opinion, to sell and pay the taxes when you're going to go out and buy more investment property. I can't think of a really good reason to do that. If your goal is, maybe you can't because of market conditions, right? Maybe inventory is so tight, you can't find anything, so it's problematic, but you can always work on your purchase. When I do my exchanges, I'll actually get my purchases locked up before I even list the property I'm selling. So it takes a lot of the stress out. I know exactly what I'm getting out of, and I know exactly what I'm getting into. And then it's just a really seamless transaction after that.
Okay, so explain that process, the nuts and bolts of it. What are you putting in your contract that you're buying? Are you saying, hey, this is predicated on me being able to sell this and we're going to have a long closing period, or how does that look?
The ones that I've done, so I'm a turnkey buyer, so I buy turnkey assets. I'll just work with a provider I know, and I'll say, hey, I'm selling over here. It's going to sell for, let's say, $400,000. I need 4 assets that are going to equal this. Can you carve out some? And they'll line them up, take them out of their pipeline, and just set them aside for me. Then I list my current property. I know what I'm going into, and then I've only got then a few weeks between when I close on my sale and the purchases.
Got it.
If you're just doing it off the MLS, it's going to be a little trickier. Those are more relationships. You can always get a property into contract, a contingent, right? So I'm going to buy it contingent upon my sale. I'll take your price and purchase it for the price you're asking, but I'm going to need you to be a little flexible on the sales side, the one when you're buying it, on the closing, right? Instead of closing it in a month or two, you might have to have it open for me under contract for a few months so I can get my sale property sold. So that's a typical way. Contingent offer, not as strong, but it happens all the time.
Yeah, I think now it's probably a better time to do that than 22, 21, when it was just going gangbusters, a little bit more difficult for sellers.
Not a chance back in the boom era there.
Yeah, exactly. And you mentioned something just now about buying from turnkey. So basically when you're buying those as a strategy, are those turnkey guys typically selling to investors below full retail?
No, actually, I think they're selling at full retail.
Okay.
They've got a lot of demand. When I do a turnkey, and let me just describe it, it's where somebody else has basically done the fix and flip. They're going to pick up an asset in Memphis for $60,000 that's dilapidated. They're going to put 30, 40 grand into it. They're going to put a new roof on, new mechanicals, spruce up the kitchens, the bathrooms, landscape it. So let's say they bought it for 60, they put 40 into it, and they're going to sell it to me for 130, 140.
Yeah.
So I'm buying a full retail, but the reason why I like those, I'm not going to have any of the major CapEx to deal with for the first 10, 15 years. My roof's done.
Mm-hmm.
I'm going to get a little higher quality tenant because now instead of it just putting a little bit of fresh paint on it, I've got a freshened up kitchen with stainless steel. I've got nice LVP in it. It looks fresh and clean. So it's going to attract a better tenant. I put in low maintenance things like that, right? LVP versus carpet. So it's going to be a little bit more bulletproof. I freshen up the yard, so it's got curb appeal. So for me, buying retail, I'm okay with it because I'm going to buy and hold long term. And for me, what I want is I want investments that I don't have to be actively managing and having the turnover. I want just kind of plug and play, put a tenant in there for 1, 2, 3 year lease. Hopefully they like it. I'll keep the rent bumps down a little bit and they stay long term. And then I reduce my tenant turn costs as well.
Yeah. Nice. So are they giving you a tenant at close?
Most of them do. Yeah. A
Yeah.
good provider will do that. It varies, right? When you say turnkey provider, there's no one standard.
Yeah.
But a company that, some of the companies I like working with, they'll have a tenant in tow right when I close on it. So now I don't have it sitting there vacant for a few months where I got negative cash flow.
Yeah.
Everybody wins with that deal.
Yeah. Yeah. For sure. No, I've seen those guys. I know a lot of guys were doing that in Phoenix, or there was a big provider out in Phoenix, but I haven't looked at it on a nationwide scale just to see who those guys are, who the players are. So good strategy. Solid.
Yeah, it's a cool niche. Where I think it's neat is a lot of people think investment real estate, oh, it's a lot of work. I got to manage it. I tried to self-manage years ago and it's not for me. So I'm happy to outsource all that, pay an 8% fee to somebody to take all the phone calls and the hassle. That's just into my analysis of an asset, right? So I'm going to get a little less cash flow. But if you stack up enough assets, you're still going to end up with decent cash flow at the end of the day.
Do you have any plans long-term to exit most of the single families and roll into one, a 1031?
Yeah, great question. I'm sure I'll consolidate some of the assets. Believe it or not, I'm bullish on the single family niche. I just think we've got, depending on who you listen to, 3, 4, 5, 6 million units underserved, right? We just have too little inventory. So I like the niche. I get good returns. So I'm not of the belief that you always have to scale up and go to commercial. I can stack up a portfolio of single family and get kind of like returns by just having a bunch of small assets. Yeah. I'm sure there'll come a time where I'll take some of them, and maybe roll it into a small apartment complex or something like that, just to have a little less management. But at this point, I'm good. I'm fine with the single family assets, and I'll just keep scaling, with those types.
Yeah. Yeah. Nice. I mean, the cash flows on the apartments have been compressed a lot lately. So yeah, now maybe not best time to do that, but you could take your own strategy and go into a tick, man.
Yeah. It's real estate. There's no one way to do this, right? You can make money in ticks and you could do it in industrial and self-storage, right? There's a lot of different ways to do it. What I like about single family, if I were to share my bias, is you get 30-year fixed financing. Yeah. So I scooped up a lot of assets with the lower debt. So I've got low debt for basically forever, right? For 30 years. When I'm dealing with commercial, I've got a refi. I mean, there's going to be a lot of carnage in some aspects of the commercial real estate. There's something like $1 trillion of loans resetting right now. And everybody's playing, extend and pretend, but eventually they're going to have to deal with that. There was an asset, I don't know if you heard about in St. Louis that, and I forget the numbers, don't quote me. It just traded last month for $3.5 million. And I think it traded before at $120 million, a downtown office asset. Now, I don't think that represents the market, but the point is downtown Class A office, that stuff, because of just changes in work environment, there's going to be some challenging stuff going on. So I'd rather just keep making little base hits with the single family. It's nothing sexy, but it gets the job done.
Yeah, for sure. No, I mean, to that point, like I've started looking into multifamily and had to pull back and just stay with some single family stuff just because the way the market is and the way the debt is on some of those things. So
Randal, where do you invest? Do you invest locally then in Arizona?
Locally, yeah. I have an asset in Atlanta, one in Dallas. Those are larger multifamily deals, and then a lot of single family stuff here in San Antonio. So yeah, we buy, we've got a fund that we are basically buying single family houses and then owner financing those. So we're providing the debt for the end buyer. And so I'm keeping the notes and just going to stack those. Yeah. That's the majority of what we're working on.
Cool. No, that's great. That's a fun niche.
Yeah. Yeah. So, well, hey, Scott, man, I appreciate you jumping on, sharing your knowledge. You are dropping like text code this. Obviously, you have a wealth of knowledge. So I appreciate you jumping on and sharing that information with us. If anybody's looking to do a 1031, your contact information is going to be in the show notes. By all means, reach out to Scott directly and have a chat with him about it. So thanks for coming on.
Cool. Great visit with you. A lot of fun. Thanks.
Yeah, good catching up with you. Thanks.
Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.